All right, let's go ahead. Let's bring on Thomas Hayes. How we doing? Welcome back. It's good to
Doing
have you
great,
back.
Mitch. Glad to be here, Mitch. Thanks for having me.
Yeah, excited. I just saw something hit the tape, so might as well just ask you about what do you think about it, Thomas? So I just saw right now Boeing's Dreamliners deliveries to resume in the coming days. It's of course coming from the FAA. How do you feel this will affect Boeing? I know we've had some recent delivery mentions, but it seems like this is a really good outlook for Boeing here.
Yeah, I love this type of headline, Mitch, because Boeing has been a chronic disappointer for the last year
Yeah.
and a half. I mean, it's just been tape bomb after tape bomb, mismanagement after mismanagement. And what I like about the stock here, Mitch, is the fact that no one's paying attention to it anymore. Everyone's been burned on Boeing. They've given up on the stock. And now that good news is actually coming out and the stock is silently moving up, you hear no one really talking about it other than guys like you who are paying attention to everything. And I think it's a sleeper that could do very well over the next 12 to 18 months. So good to see this good news, but no one's paying attention, and that creates opportunity for smart value players.
Definitely, it's been hanging on too. I would think that it was going to pull back, but it just hung on to this trend, this recent trend. So it's going to be a fun stock to keep on watching, especially if you hear more and more mentions of deliveries of that 787 Dreamliners that has been halted for 2 years. I
Yeah.
mean, it's been a while since we've heard that kind of get the resume. And I think everyone was watching the FAA if that news was actually going to hit the tape. So there we have it. Let's get out of that. Let's talk a little bit about. I'm going to play a fun game with you. Let's do over under on the CPI estimate. 8.7, of course, the estimate. And the next question following that would be, how would the markets, you think, react towards that if it's over or under?
I think it's going to be under. And if you look at the Cleveland Fed, they have some real-time inflation metrics. It's actually pointing to 27 basis points up year on year for July, which would be about 3.4% annualized. If that's the case, that's going to take the market by storm. And it may, in fact, negate what we saw from Friday. That jobs report came out super, super hot and kind of put the Fed pivot narrative on the back burner in the short term with that many jobs created and the unemployment rate at 3.5. Everyone had been kind of positioning for a pivot in September. That took that off the table. But if you do see the under, like I'm talking about here, it may bring that back on the table. So we're pretty optimistic looking at the Cleveland Fed data. We know that commodities work on a lagged basis. They rolled over in June. You're starting to see a little bit of in the cash register. Even Elon Musk said we're past peak inflation. He's seeing it in component parts for his cars. So that would be a very pleasant surprise and potentially offset the good news, bad news of Friday.
Yeah, now if we do see it come in under, all right, so the scenarios hit, let's say, I don't know, well, let's say 8%. How will the Fed be handcuffed here, or will they not be handcuffed here if they start seeing inflation turn around? Of course, we saw the increase in the jobs number. That's why I think they are a little bit handcuffed here, because there's a strong labor market, but of course, their main focus was inflation, and they're starting to see it trickle down. What will they be left to do?
Well, if it comes in under, that gives them the ability to raise less than anticipated, which is what the market would like to see with inflation coming down. So, the fact, what you see a lot from the Fed at this moment is jawboning more than action. And the reason that they're doing jawboning and no one's really talking about it is the fact that our debt to GDP ratio is 125. They're limited in how high they can go without making the debt servicing unsustainable. So they've been doing a great job of talking inflation down, talking demand down, slowing the economy down. But if you think about it, Fed funds rate at 225, 250, that's where we peaked at the last tightening cycle in 2019. So, without what we saw on Friday, it wouldn't have surprised me if we saw a pivot in Jackson Hole. With that strong jobs report, it's probably going to be delayed until September. Maybe we get one more hike. But the key, as you said, will be the CPI and the PPI numbers this week. And we're definitely taking the under. They've been stubbornly high, but I think on a lag basis, we're now going to see it The other thing that's critically important as it relates to inflation, everyone always looks at energy and commodities, but it's used car prices and new car prices. They've been unnaturally high because the demand exceeded supply, and that was largely a function of a shortage of auto chips. Well, you spoke to the NVIDIA pre-announcement that their earnings were going to be weak on the basis of the consumer side, video gaming, crypto mining, et cetera. We've seen that across the board, whether you're talking about Taiwan Semiconductor, NXPI, Texas Instruments, Qualcomm. They say the consumer and the consumer electronics side is all slipping. PC demand is slipping. But guess what that's created? They've been able to reallocate capacity to auto chips, and that demand is backlogged for 2 years. New car demand is backlogged for 2 years. And as those chips continue to roll in, which all the auto suppliers spoke to on their calls, they started to roll in the last 4 weeks of June after the China shutdown was done. Ford maintained their full year production guidance and earnings guidance. GM maintained their full year production guidance despite having such a horrible Q2. So as those chips roll in and you see the massive new car production and those 100,000 cars that GM couldn't get off the lot because they didn't have chips now getting onto the lot, that's going to bring down used car prices dramatically as a glut of new cars come online, and that's going to bring down inflation dramatically. So I'm less worried about inflation than most, albeit we just passed a big spending bill in the Senate. I know it's called tax and spending, but we know what it actually is. So the market's kind of trying to digest that if that gets passed in the House, which it likely will. But all in all, inflation, I think, certainly has peaked, and it would be nice to see it show up in the numbers this month, optimistically, and certainly by next month on a lag basis. But I'm definitely going to take the under.
All right. Now, what opportunities are you seeing arising from the passing of the Climate Inflation Reduction Act? Is there any opportunities that are rising? I know that JP Morgan coming out with that call on First Solar about potential 20% upside. Do you see any opportunities coming out of this bill?
Well, I think the buybacks are going to be accelerated. I think companies are going to now, they've got record cash on the balance sheets. They're going to now look to the tax kicking in 2023, and all the buybacks they have slated in their authorizations for 2022 and 2023. I think we're going to see a lot of that accelerated into the end of 2022 so they can do it without the tax, and that's going to create a natural bid for the market. I think the other thing you saw today on the news was biotech was up big this morning. It's cooled with the market since, but it's still positive on the day. And people were scared about this drug pricing provision. And the good news is it's less punitive than anticipated in that it doesn't go into effect till 2026. It only goes into effect on a small number of drugs starting 4 years from now, and on no drugs in the first 13 years. So it's only off-patent drugs that this could potentially affect 4 years out. And I think the drug stocks and the biotech stocks got bid, and they've continued to follow through. I know we've been on your show many times since May, which was the lows, saying biotech, biotech, biotech. Well, now you've got the XBI some 40% off the lows since June. And we think if you look out over the next year and a half plus, it's just the beginning. You've seen animal spirits with a lot of deals, even one deal announced this morning, Pfizer buying Global Blood Therapeutics this morning, another multi-billion-dollar deal. That's, we're approaching a couple of dozen, and just in the last 2 months, animal spirits are back. A lot of drug approvals now coming through the pipe as the FDA takes its focus off of COVID and puts it back on drug approvals. The trials are back in effect now with people willing to participate in the trials. So those are some things we look at. But back to the point about auto suppliers, which I know we've talked about on your show as well, this was wholly dependent on the chips coming in because the demand for new cars has been pent up now for a year and a half. They just haven't been able to supply it. I think there's going to be a huge opportunity in our third largest holding, which we may have mentioned with you in the past month or so, was Cooper Standard. They reported on Friday they were up 69.83% on Friday. That's a long-term play. The reason it was so beaten down was they've got some debt they have to refinance before the end of the year, which we think that'll get done. Management said as much on Friday's call. And that stock has followed through today, which was nice to see after such a big move on Friday. But if you look out 3 to 5 years as they get back to normalized EBITDA, this could be a many multi-bagger in our view.
Something definitely I want to keep an eye out is how that reports on the CPI. And so I'll keep watching exactly what you're mentioning there. Do we start seeing that shift? And will we start seeing some kind of new sales really start getting off the line? Because a lot of that issue has just been, like you said, not having the chips. And now if we are going to get that kind of push in the chips because, of course, the turning away from the gaming, that could definitely drive some of these stocks. Now, one area that I have to ask you in is, of course, is oil. Are you bullish or bearish oil stocks from here? It's been a tough call. I would like to see how you look at it.
Yeah, well, we were pound the table bulls on oil stocks in 2020. We sold them off earlier this year in the Russia war strength, and maybe a couple of months too early, but that was a huge trade for us over a year and a half. Made a lot of money there. And now looking forward, we've been less interested. We said the trapdoor was going to open sometime in the middle of the year. All these people chasing oil who hated it in 2020, loved it in 2022 when it was at the top. The trapdoor was coming, and sure enough, it is. And the trapdoor has knocked a lot of wind out of these stocks. So I'm not an aggressive buyer. The other thing that no one's really paying attention to is the rig count. That rig count now is 670 or so, 674. I'm sorry, 764. That's down from 790 pre-pandemic, but it's up from 244 at the pandemic trough. So that is a big factor that while everyone's looking to beg Saudi Arabia to pump more oil, we've got a lot coming online in the United States, and I don't think people are fully accounting for that moving forward. So I'd say I'm agnostic here. I don't chase things that are up. I buy things when they're out of favor, and then I wait for everyone to get interested in them, and I lay it off. So we just do that over and over. Talk to me about some things that no one loves, and I'm interested.
There you go. There you guys have it. Something to keep on watch, the U.S. rig count. I appreciate you, like always, Thomas, bringing a little bit of extra. Now, the last thing I'll leave you off to is there any kind of plays that you're watching to kind of continue moving? Is there any opportunities you like right now?
Yeah, I certainly think you want to keep your eyes on the auto suppliers. Now that the chips are coming in, they make their money when OEMs, Ford, GM, et cetera, ship cars. And now that they're going to start shipping like crazy with the chips coming in, the auto suppliers have huge operating leverage. They've been kind of in the bullpen. Now they're on the mound, and they're going to start throwing strikes left and right. Pay attention there. Biotech is going to continue to follow through. And I know, China tech, I'm like a broken record. It hasn't worked yet, but that's going to be a trade. The number one thing you need to see if you're skeptical about China tech, just watch the US dollar. If you do nothing else, if that US dollar continues to weaken into year end, you want to be in emerging markets, and China is the heaviest weight in emerging markets. So if you don't like China, just wait tight until you see that dollar start to crack, and that'll be your signal to maybe get some exposure.
All right, we'll see what happens. I know a lot of people are thinking about China, but probably in another sense. They're thinking about worrying here, and you're completely giving us another side to keep an eye out. Appreciate that, like always. Thomas Hayes here, chairman and managing member of Capitol Hill. We'll definitely have you back on.
Thanks so much, Mitch.